Hi, my name is James, and today we're going to discuss the yen carry trade and see if we can make some money. It's very simple how it works. So say the Bank of Japan is offering you 0%, but the United States is offering you, say, 5%. What happens here is it makes sense to take out a loan in Japanese yen, convert it on the foreign exchange to US dollars, and then park it into a US bank, and then make a 5% yield, the difference. And what happens is, as people do this, this causes the yen to depreciate because he's selling yen, or taking out a loan in Japanese yen, and then converting the foreign exchange to US dollars. So you're selling yen and buying US dollars. And what this does is it depreciates the yen. So what we can notice here is as the yield gets bigger, so the interest differential gets bigger, so the difference between US banks or the interest offered in the United States and the interest offered in Japan gets bigger, more people pile in. So this causes the yen to depreciate because there's more selling pressure, more loans being taken out in yen and put into US dollars, and then put into US banks to collect that yield. But what happens is when this yield collapses to zero, you can see a massive collapse or the yen carry trade unwinding. And what you might notice is when the latest round of inflation kicked off and interest rates rose in the United States, this interest differential blew up again and the yen carry trade started again. So how do you make money on a carry trade? Well, one is the spot difference and two is the interest differential. So as the interest differential in 1997 went up to about 4.5%, as we see here, about 4.5% difference between here. And what happens is we're also making money on the spot difference because people are taking out loans in yen and selling for US dollars. This causes the yen to depreciate, and this is how you make money. So you make money not only just on the differential, but on the spot difference. And what happens here is we make a good yield, about 14% per year. So how can this go wrong? Well, it's very simple. When everyone wants to rush for the exit because, say, this differential is coming down, so the Federal Reserve is cutting interest rates in the United States, and the Bank of Japan is keeping theirs the same. Well, now everyone wants to exit all at once. This floods the foreign exchange because to exit, you must basically take US dollars that are parked in the United States, sell them on the foreign exchange for Japanese yen. So you're selling USD and buying yen, and this causes the yen to appreciate. And we see a massive collapse. So now you lose not only the interest differential, but you also lose spot difference, which results in about a 17% loss in 1998. And in 2008, we had the same thing. We can see the yen carry trade unwinding as a result of the interest differential coming towards zero because the United States, or the Federal Reserve, cut interest rates to zero in the United States. So what happened was people lost, or investors lost, who were doing this yen carry trade, 16%. So why is the recent period of the yen carry trade very important to look at? It's because the Federal Reserve is cutting interest rates into the Bank of Japan raising interest rates. So what might actually happen is this interest differential is closed very quickly, and all these investors rush to exit the trade. And remember what happens here is they sell a lot of US dollars and buy a lot of yen, so this will cause the yen to appreciate very quickly. And why it's unique is because the Bank of Japan has kept their interest rates relatively near zero for the last 30 years, whereas the Federal Reserve has been the main one we've had to look at for changing their interest rate, for looking at the yen carry trade. When both are moving, it becomes a lot more risky because if this goes up, or if Bank of Japan raises interest rates up and the Federal Reserve cuts it, we could have a very big exit of the yen carry trade.